According to data from the Capital Markets Authority, day trading of shares accounted for only 3.4% of total deals at the Nairobi Securities Exchange, reflecting investors' apathy towards buying and selling securities multiple times in a single day. We are joined live by senior equities analyst at Genghis Capital, Kevin Gige, for more. Kevin, it's great having you with us today here on the show. Just what has been the contribution of day trading to NSE's turnover?
For having me, Fiona. It's great to be here. So the NSE launched the day trading app around last year, November, and it was posed as any other country, especially in the Western side, to boost liquidity and of course boost fees for for NSE and other regulators, and of course eventually boost transaction volume and profits for traders. But that hasn't stood to expectations, as you mentioned. Only about 784 million worth of shares was traded. If you look at NSE, this is a market that trades around 22 billion monthly in Kenya shillings. So that's roughly around 3.4, 3.5% of traded volume. So it hasn't really stood up to investors' expectations.
Yeah, so as you said, it hasn't played out to expectations. Why would you say that there is investor apathy towards the trading at the NSE?
So if you look at the fees levied, the NSE decided to give investors a 5% discount. That means per leg of trade. So if you buy and sell shares, so you buy and sell, that means roughly you're looking at around 2% of fees. So for a stock to make any sense to you to do or to participate in the day trading, it means you'd roughly need to, or the stock would roughly need to vary in price, or what we call volatility, of around 4%. To make any meaningful sense to you. So that has been a key hindrance to investors, because most of our stocks, if you look, the big stocks, equity, KCB, Safaricom, it's very, very rare that you'd see a stock move up by 4% in a day.
Yeah, and just taking it a step back, to spur more investor appetite, we saw the NSE provided a discount on the pricing. Would you say, has this made a difference as far as cost is concerned?
Not at all. I mean, it's a 5% discount from the normal cost. So if I tell you I'm going to give you a 5% discount, it means I'm charging you 95% of the full price. So if you say you buy Safaricom stock today, and you remember you have two sides, so you have the buy and you have the sell. So if I'm going to charge you roughly 2%, and that's all regulators fee inclusive, the CMA, the CDSC, the NSE, you name it. So if I'm going to charge you roughly full price for the full size, it means on a buy and sell side, I'm only giving you a discount of 10%. That is not reflective on the range of prices in the stock. So normally you'd find, and the most active hours, of course, would be the opening hours, sometime around 1, which is mid trading day, and maybe an hour, 30 minutes to close. So on a normal day, it's very rare that you'd have 4% range in prices for it to make any investable sense to you. And that means, I mean, we've had this push where we are pushing NSE and telling them, if you look at the developed side or the developed markets, you have at least 50% of the cost as discount. So that would incentivize you, because it means once you do a buy and a sell, then that's when you're fully charged the full price. So you're having the price of, you're buying a half for the price of one. Then that would definitely boost liquidity, but that's not the case in here.
Yeah, on one hand, it did not, as you said, gain as much momentum from the investors. But now just looking at brokers, they were concerned that volumes are so low, so that they cannot quite give discounts. So how will it play out for brokers?
So there are a couple of things panning out on this side. So one, we have our general elections. On these markets, during a general election, considering the trend we've had before, is market activity generally slows down. Our market is around 67 to 70% dominated by foreigners. So when foreigners look at an election in a country that lies under the emerging or frontier market, then the tendency is to pull out capital. So we have such capital inflows. Of course, we are now in the new normal, which is the pandemic. So the market activity hasn't fully rebounded to levels we were pre-pandemic or levels we'd expect to be. So you couple that with punitive fees from regulators for day trading, then really that doesn't make any investable sense to you. And NSE has tried in, bringing up new initiatives. We've seen the trading of futures on equities, on indexes and single stocks. We've seen introduction of, the GEMs, the smaller stocks being listed for the smaller, for the citizens who can't afford the big stocks. we've seen all these things, but unfortunately, the day trading was expected to boost as nowadays we trade from our mobile phone, so seated at the comfort of your house, you can take your phone, see the stock, say Safaricom is at 37, buy the stock, and hopefully by the end of the day, the stock is around 41 or 42, and you can sell the stock. So that would make sense. One, if those fees made sense, like I told you, a 50% discount is what brokers are asking for. And two, if we see some price variations on the stocks. Again, both of those have not happened.
Yeah, and day trading was supposed to attract a certain demographic to the bourse, that being the youth. Do you see this happening?
Sorry, say that again?
Yeah, we saw day trading was supposed to attract more youth to come to the bourse. Do you see this succeeding?
Unless the things I've mentioned previously, especially on the cost change, I don't see that happening. Like I mentioned earlier, the NSE investor has become quite sophisticated. They become technology savvy. So most guys trade from, I think, 80% of those day trading or investors seated at home just trade from the comfort of their laptops or their mobile. So yes, the target is there. That is the youth and most of the young people. But the punitive costs are what is hindering them from partaking in this day trading.
Yeah, as you said, market activity is yet to rebound, mainly due to the pandemic. This is an election year. So what potential lies ahead for day trading?
In the meantime, again, they have to address, and I've been mentioning this for, I think, since November, since the introduction of day trading, the costs have to be addressed. So assuming the costs are addressed, I think we'll have 2 quarters. Normally, we have the first Q1 and Q2, and that means January to March and April to around June, where we have quite some market activity. And then thereafter, things slow down since our election will be on 9th of August. That's the second Tuesday of August. So that will be in Q3. We don't usually expect quite some activity in Q3. Of course, people take a wait and watch approach as they see how the election will pan out. So should the costs be addressed, I expect day trading to really take off in Q1 and Q2, and hopefully Q4 post the elections.